Imagine for a moment that you've just landed in Toronto Pearson International Airport. You step outside into the cool Canadian air, expecting the seamless blend of polite efficiency, booming tech hubs, and scenic parks you've always heard about. You imagine a country with a high quality of life, a strong social safety net, universal healthcare, and a reputation as one of the world's most stable economies. You think you're entering a success story, but what you see over the next few days tells a different story. Streets that once buzzed with construction sites are quieter than you remember. Young people with degrees, ambition, and talent tell you they can't afford rent. You notice empty condos, slower traffic downtown, businesses closing, and conversations among locals about rising debt, stagnant wages, and a future that doesn't look as secure as it used to. What you are witnessing isn't a sudden crash. It's not a spectacular boom and bust moment like 2008 or the dot-com crash. What you're seeing is Canada quietly falling apart from within. This is not hysteria, and it is not fear-mongering. This is a grounded, analytical examination of the forces, economic, demographic, cultural, political, and structural, that are unraveling one of the world's most admired nations. In this episode of The Calm Capital Historian, we will ask the difficult question: is Canada still the prosperous nation it appears to be, or are cracks deepening beneath the surface? And most importantly, we'll explore what this means for everyday Canadians, global investors, and anyone trying to understand where one of the richest countries on Earth is actually heading. Let's begin with a question that goes right to the core. What does it mean for a wealthy, developed, stable nation to quietly fall apart? It does not look like a financial panic. It does not look like riots in the streets. It does not look like the banking system collapsing. It looks like an erosion of confidence, an affordability crisis, a government glued to short-term fixes, and the very foundations of economic growth beginning to fray. To understand this, we have to break the story into the forces driving Canada's slow decline. If you ask most Canadians what the biggest problem in the country is today, there's a good chance the answer involves housing. For decades, housing in Canada was a symbol of prosperity. A home was something you bought, not something you rented forever. But that narrative broke long ago. Canadian housing prices soared dramatically in the post-pandemic years, making ownership increasingly unattainable for many middle-class families. From national averages that doubled prices in major markets like Vancouver and Toronto to regional spikes well above the rate of wage growth, housing moved from being an asset to an anchor around people's necks. Nearly every study on Canada's housing crisis points to one stark reality: affordability is not just declining. It is collapsing under the weight of debt, speculation, and financialized lending. And it's not just anecdotal. Canadian mortgage debt has ballooned beyond imagination, exceeding $2 trillion, a figure that now amounts to roughly 85% of Canada's entire GDP. The same banks that profit mightily from the mortgage boom are also the lenders whose practices have amplified this crisis, fueling inflation in house prices while average incomes stagnate. Young Canadians today face an impossible choice: commit to decades of debt to buy a modest property, or rent indefinitely in a market where rent continues to rise faster than wages and savings are devoured by monthly payments. This crushes the ability of young people to save, start families, and invest in their futures, slowly hollowing out the very middle class that once defined the nation's prosperity. And here's the cruel twist: while housing remains expensive in many markets, recent data shows prices have been falling year over year in late 2025 as inventory builds and buyers retreat, a sign not of recovery, but of instability. This shape of change, prices dropping after years of unsustainable rises, is exactly how debt-fueled bubbles unwind. If housing is one wound, everyday cost pressure is another. Despite inflation slowing compared with the monstrous peaks of 2022 and 2023, Canadians continue to feel squeezed in their daily lives. Nearly 6 in 10 Canadians report that rising prices are significantly affecting their ability to afford basic necessities like food, rent, and transportation. For lower-income households, the pressure is even worse. Most people at or near the bottom of the income distribution describe everyday expenses as stressful or overwhelming. And when people cannot absorb price increases in essentials, it erodes confidence, consumer spending, and long-term financial stability. Almost half of households with children report financial difficulty meeting daily needs. In some communities, the reality of choosing between feeding a family and paying rent is not theoretical, it is everyday life. This is perhaps the most unromantic and least reported part of Canada's story today, the lived experience of struggle beneath the veneer of stability. Canada has long relied on immigration as a lever for economic growth. But recent policy changes and demographic shifts are creating new challenges. Canada's population, which has been one of the fastest growing among advanced economies thanks to immigration and international students, declined in the third quarter of 2025, one of the largest drops on record, as student permit numbers were cut dramatically by the government. This is a seismic shift. For decades, Canada's growth engine depended in large part on newcomers, young workers, skilled professionals, and students who contributed to labor markets, productivity, consumer demand, and tax revenue. Suddenly curbing that flow without a clear alternative puts downward pressure on population growth, labor supply, and economic dynamism. Population growth underpins everything in a modern economy. Housing demand aligned with wages, job creation, productivity, tax revenue to fund social programs, and the ratio of working-age people to retirees. When that growth reverses or stagnates, the ripple effects hit every corner of the economy. But population is only part of the story. Canada has historically struggled with a productivity gap compared to peer nations. Despite abundant natural resources, a well-educated workforce, and access to major markets, Canada's labor productivity has stagnated relative to countries like the United States. A lack of investment in technology, research and development, and innovation means that Canadians are producing less output per hour worked than they could be, a structural weakness that shows up in slower wage growth and reduced competitiveness. Put simply, Canada's workforce is growing, and then shrinking, but productivity per worker is not keeping pace with nations that are racing ahead. Sluggish productivity translates into stagnating real wages for workers, reduced business investment, and a shrinking share of prosperity for everyday people. When you look at Canada's official GDP growth figures, they tell a complex story. On paper, the economy grew at various points in 2025 and recovered after slow patches earlier in the decade. Inflation has moderated substantially from the highs seen during pandemic and post-pandemic periods. But headline numbers can be misleading. Behind those modest gains lies evidence of what economists call a K-shaped recovery. That means certain sectors, like finance, insurance, real estate, and asset holders, are doing reasonably well, while the productive economy, manufacturing, construction, sawmills, and other sectors, is contracting. This kind of divergence is insidious because it masks deep structural weakness. Asset prices, like equities and some real estate segments, can buoy GDP figures, while the everyday economy that employs millions of Canadians weakens. And slower economic growth is not just a statistic. It has real consequences: fewer jobs created, less income growth, reduced tax revenues for public services, and diminished ability to invest in future productivity. Forecasts for 2026 and 2027 suggest modest growth at best, with some forecasters projecting growth well below historical norms, highlighting ongoing uncertainty and potential stagnation. This emerging picture is not one of a booming economy. It is a picture of fragile stability with deepening structural problems beneath the surface. Canada's household debt levels are staggering. When mortgage debt alone tops $2 trillion, any shock, interest rate hikes, job losses, or credit tightening can reverberate across households, banks, and the broader economy. High household debt is not just a number, it changes behavior. When people are heavily leveraged with mortgages, credit cards, and loans, they become extremely sensitive to interest rates and economic shocks. They spend less, save less, and are pushed closer to financial distress at every economic twist and turn. That fragility creates what economists call systemic risk, a situation where the financial health of households, banks, and the economy becomes tightly interconnected in ways that can amplify downturns. And when housing is both a liability and an essential good, the risk multiplies. Some analysts warn of a possible property correction, not necessarily a crash, but a period of price adjustments and distress. As more inventory comes on the market, buyers retreat, and debt burdens become harder to service. Add rising mortgage payments expected in coming years, as many Canadians renew fixed-term mortgages at higher rates, and you have pressure building under the surface that could weaken consumer confidence and spending further. This is not a house price bubble narrative repeated online. It is a financial vulnerability embedded in everyday life. Canada's political landscape is being reshaped by these economic realities. Debates over immigration policy, housing reform, federal spending, internal trade barriers costing billions annually, and how to stimulate productivity are now front and center in national discourse. Policymakers face a difficult balance: how to slow housing inflation without crushing demand, how to maintain social services without ballooning debt, how to improve labor productivity without slowing growth, and how to attract global talent without overwhelming infrastructure. Trade tensions with the United States, still Canada's largest trading partner, also pose risks, especially when tariffs, retaliatory measures, and policy uncertainty loom large. Even risks to financial stability have been raised by the Bank of Canada in the context of a prolonged trade conflict. This complicates governance, dampens long-term investments, and makes public policy more reactive than strategic. Numbers and policies are one thing, but what about the lived reality of Canadians? For many young people, what was once a promise of growing prosperity has turned into anxiety, stress, and uncertainty about the future. Reports highlight that the relentless combination of unaffordable housing, stagnant wages, rising costs, and a precarious job market has had real psychological impacts on younger generations. When people constantly worry about debt, cost of living, the future of their careers, and whether they will ever own a home, it reshapes the social fabric. Confidence declines. Family formation is delayed. Birth rates fall. Community engagement suffers. This psychological erosion, the quiet loss of hope among large segments of the population, does not show up immediately in GDP figures, but over time it can shape social cohesion, consumer behavior, and political outcomes. Is Canada collapsing? Not in a dramatic, chaotic way. There are no scenes of banks shutting down or markets crashing. There is no instant catastrophe. What we are witnessing is something deeper, slower, and more insidious: an economy under stress, a society stretched thin, and a future that feels much more uncertain than it did a decade ago. Canada still has enormous strengths: natural resources, educational attainment, political stability, diplomatic influence, universal healthcare, cultural diversity. But these assets alone cannot sustain growth without addressing the structural weaknesses that we've just walked through. The overnight crisis is not imminent, but the long-term stagnation trap is real. Demographic headwinds, debt burdens, housing unaffordability, productivity stagnation, and policy paralysis are forces that will continue exerting pressure unless bold changes are implemented. And for everyday people, the question is not, will Canada collapse tomorrow? It is, will Canada still offer widespread prosperity, opportunity, and stability in the decades ahead? That answer depends on choices that are being made right now by policymakers, investors, businesses, and citizens themselves. Canada's story today is not one of sudden collapse, but of slow convulsion beneath the surface. It is a nation confronted by economic, social, and demographic headwinds that have quietly, persistently, reshaped its trajectory. And while there is reason for concern, there is also reason for informed action. Structural reform, investment in productivity, thoughtful housing policy, and resilient long-term planning could yet change Canada's economic destiny. But to influence those outcomes, Canadians and observers around the world must first understand the reality, not the image, not the myth, but the deeper, more complex truth. This has been another deep dive from the Calm Capital historian. If you found this analysis enlightening, thought-provoking, or simply worth sharing, please share it with someone who wants to understand not just where Canada is today, but where it is heading tomorrow. Stay curious, stay calm, and until next time.